Hey guys, this weekend's market outlook will be short and sweet. As you all know, my focus is on something else these days. In fact, this morning I got up at 4 a.m. and I've been running back tests ever since. Again, I'm only one person, so there is only so much I can do. But the market outlook is going to be really easy, so there's nothing complicated. So let's look at the chart for SPY to begin with. So these are my regular indicators, and as you can see, the white arrow that you see at the top, if you remember, that is that MRI indicator that I developed, I would say like 9 months ago, but it generates false positives. So I haven't released that indicator to all of you, but whenever it triggers a reversal, I do point out in my videos that it's triggering a reversal, and it did show a reversal on SPY on September 3rd. So until that arrow changes, trend is downwards. Other indicators that are obvious here are a DMI crossover that happened actually on 8:30, way before my MRI indicator showed a reversal. A DMI crossover has happened, and if you remember, DMI crossovers are considered very important by market technicians as far as trend change signals are concerned. And especially if you apply a DMI indicator to the indices like SPY, DIA, QQQ, they become even more reliable. So DMI crossover has happened on 8:30, and you can clearly see that the DI plus is sharply pointing up and DI minus is down. If you look at RSI, it's dropping like a rock, and we are still not in oversold territory. So oversold is way down here. So that means there is more room to fall. Now, next week, as usual, we do have macroeconomic data that's coming out, which is our favorite CPI and PPI. And as you know, these are massive market moving events. So I do want to point out that if you look at SPY, it's at an area of support right here. I would say 538. It's almost at that point. So if CPI comes out good and it shows slowing inflation, this is that point where we can get a reversal instantly. So just be prepared to get a bullish reversal if CPI is good. Of course, since this is a long-term area of support, it's also very important because if CPI is bad and we breach this support, then all bets are off. Then the next level of support is somewhere around 524. So expect markets to continue dropping until SPY hits 524. And I would imagine that would be the time when RSI would become oversold, officially become oversold. And then that would give us another area for a bounce. Having said that, I do want to bring a question which one of our members had asked in the group. So if you remember, I've been recommending that you split your trading allocation 50-50 during the week. So let's say you're allowed to take 4 trades a week. You take 2 trades on Monday or Tuesday, and then you save the 2 trades for Friday. And the reason I've been suggesting that is because we are living in a inflation obsessed environment, and literally every week we get some kind of macroeconomic data, whether it's jobs or inflation related data. Something is always coming out which moves the markets and is capable of reversing market direction instantly. So the only sensible way to handle that is you form a directional bias early on in the week, Monday or Tuesday. You take your 2 trades and then you wait. And then you wait for Friday. By Friday, almost all macroeconomic data has already been released. And whatever the markets want to do, they have already done that. So on Friday, you can easily take a look at your two trades that you took on Monday and or Tuesday, and then decide whether you want to hedge those in case markets turn against you, or you want to double down in that direction. A member asked me this question, that since we have this hedging mechanism in place in case your bets are wrong, is there any room for quote unquote bailout trades? If you remember, um, in my original book, I had laid out this strategy for how to deal with corrections, and the strategy was really simple. You never trade more than 30% of your portfolio, and in the book, the example I've given you is a bullish environment. So markets are going up, you're constantly taking bull call spreads, and you September comes around and you get a massive correction. Now you are at a point where looking at uh, almost like I would say 4 to 8 weeks of bullish trades going underwater. And even if you cut them at 50% loss, you still have losses, right? So the goal is how to first of all how to reduce your drawdown and how to take advantage of that drop in the markets, because markets do eventually recover. And the method I laid out was, if 30% of your portfolio is already deployed, then you dip in into the next 30% to save any trades which are underwater. Not all bull call spreads may go underwater, because corrections can range between 2 to 8 weeks anywhere. So it could be a shorter correction, in which case it doesn't all your bullish trades don't have to lose. So whichever bullish trades are losing, you take them week by week and you take new bullish positions. Because now when the correction happens, all stocks are selling at a discount, so you can get into positions with better prices. So that was the mechanism I had laid out, and I had termed it bailout trades. You dip into your portfolio cash, which you have been saving 70% cash for a situation like that, and then you bail out your losers. So this member asked me the question that since we have this hedging mechanism in place, the Tuesday Friday mechanism, is there any place for bailout trades, or would we ever need to dip into those reserves? And I was thinking about it. There is a scenario where that could happen, and I'll give you what the scenario is. So let's say you've been taking bullish trades. So you took two bullish trades on Tuesday, and on Friday markets continued to go up. So you took two more bullish trades. Now you have four. Now you next week comes around, you move on to the next week. Now, if you look at the last week, you have four bullish trades. So you have delta exposure now. So it's not balanced between puts and calls. Now, at the end of this week, if markets start tanking, what do you do then? Because now the trades you took last week are not hedged. So if markets go down, those four trades have the potential of becoming losers. So that is where bailout trades still have a place in this trading strategy. So hope that makes sense. Hope that clarifies some things. Now going back to the chart of SPY, I'm going to switch to the EMAs real quick, because I only bring the EMAs into picture when there is a moment in where the markets are showing signs of a reversal. So in recent history, this is this year's chart. So this is one point in April when the blue EMA, which is your 8 EMA, 8-day EMA, crosses below the 21 EMA, and then markets just continue to tank. That's one situation. Then the second situation is opposite. So on May 6th, the blue EMA crosses over yellow EMA, which is your 21 EMA, and markets start going up. Then you get another one here on July 24th, and look how much the market tanked, reversal, and then we are again at that juncture. So the reason I'm showing you this is because I was showing you the earlier chart where SPY is nearing a very strong support area. If CPI is not good next week, obviously that support will be breached. Now, at this point, you must be wondering how much can the markets drop, because at some point they will recover. So you don't want to go crazy buying bear put spreads. And because eventually what will happen is markets will turn around, and at least with 1 week worth or 10 days worth of those bear put spreads will go underwater when markets start recovering. So you want to slow down your trading volume as markets continue to fall, so that when they do turn around, the bear put spread that you have been taking, which are closest to that point where markets turn around, are you don't have big losers. So what I'm trying to point out here is look at that EMA crossover about to happen. If CPI is bad next week, that EMA crossover which is about to happen will happen. And I expect markets to continue tanking further. So there is plenty of room for you to take bear put spreads if that happens. So, like, because I'm sure you must be thinking that at what point do I stop taking bear put spreads? So, what you could do is, in fact, I will take this opportunity to mention that the way I'm coding my trading algorithm, when the markets start tanking, so it has this flash crash mechanism built in, call it flash crash or a deep pullback. When it detects that, it actually doesn't take any bear put spreads. It just stops taking any trades. And what it does is it starts focusing instead on any bull call spread that it took recently. Tries to manage them. So on a slow basis, it starts closing them out. Also, at that same time, it's waiting for the markets to turn around so it can start taking bullish trades. So when markets are tanking, it's not gonna go crazy taking bear put spread. It'll actually wait for markets to come back up and participate in that recovery by engaging in bull call spreads. So you could, if you want, you could do that. So right now markets are tanking. If you are feeling that the markets have tanked quite a bit, in fact, let's see how much has the markets fallen. So if you look at 8:30 on SPY, we are already down 4.4%. Let's also pull up QQQ just for fun. If you look at QQQ, from 8:30 we have dropped 7.5%, which is officially not a correction. But if you go back to July high and you draw a line from there, then we are at 10.8% correction. So we are in correction territory. You could use that mechanism where if markets start tanking, you actually start only focusing on controlling your losers, which could be any bullish trades you have taken, and then don't take any bear put spreads. Just wait for markets to turn around and then start taking bull call spread. That's what my bot does. It doesn't take bear put spread when markets start going to a pullback. The only problem is that I was running some back tests on 2023 and 2024, and when that happens, I can see that the bot actually goes into waiting mode, and there could be a time where for 1 or 1.5 months, it doesn't find any bullish setups and it just waits. It doesn't do anything, and it starts taking trades after that. In fact, let me pull up a back test real quick to show you what I mean. So, okay, on 2/7, if I look at the logs, it detected a pullback beginning to happen, and I'm very pleased that it actually it picked it up just before it was about to happen. So on 2/7, it detects that a flash crash is about to happen, or call it a deep pullback, and then it stops taking any trades. In fact, this is the back test I ran for 12 months in 2023 with only SPY as a symbol. And if you notice that after 2/7, it stopped taking any trades, and the next trade it took is on 3:31, which is somewhere over here, when markets finally started to bounce back and start going up. And in this case, it was a great decision. It was a very good decision. But just be aware that this is like almost 1.5 months of waiting and not doing anything. But having said that, why trade when you're not going to win? So it's a slow paced, kind of chillaxed bot, and it just makes the right decisions. So Just wanted to bring that up to show you how you can deal with corrections. So as I said earlier, this week's market outlook will be very short. So I already laid out the plan for you for next week, and then the only thing you really need to focus on as far as macroeconomic events is concerned is Wednesday and Thursday. Wednesday we have CPI, Thursday we have PPI, and then following week, just throwing this out there, in the following week we have FOMC rate decision. So that will be interesting, but that's coming the following week. So next week, Wednesday and Thursday, we have CPI and PPI. And as you know, when these events are lined up, I prefer not to take any trades before that happens. Now, so most likely on Monday, Tuesday, I will not take any trades. I will post a list of call and put spreads for our group if you are interested in continuing to trade. So I'll do that, but most likely my first trade will come starting Wednesday. So that's the market outlook for this week. I know it's very short, but I hope it's short and sweet and gives you the information that you're looking for.